Thanks for clicking. 22% of Canadian mortgage holders say their mortgage payments have gone up since the Bank of Canada started raising rates, and 53% are bracing for an increase in interest rates in the future, according to a new poll by Angus Reid.
Ratios.
While we've seen similar polls showing that Canadians are indeed worried about the rise in interest rates, what's interesting about this poll is that it gives us a snapshot into not only the distribution between adjustable and fixed rates in Canada, but also a brief look into what the renewal market could look like going forward. So what I want to do today is go over this poll, take a look at mortgage renewals coming up within the next couple of months, and how those payments will have changed from 2017 given the increase in interest rates, and then take a look at what to look for next. All things being equal, higher mortgage rates equal lower real estate prices, and we're expecting to get the data out from Canada's local real estate boards late next week for the month of June, and I'm guessing there is going to be a fairly large decrease in prices all across the board. We'll obviously have updates out on that on this channel. If you want to get those updates, make sure you click like and subscribe, but for now, let's get into this poll. The Angus Reid poll asked respondents how the increase in interest rates have affected them thus far, with 22% saying their payments have gone up and 53% bracing for the impact of these higher rates. And judging from the data, these worries are not unfounded. Angus Reid estimates that for every 1% increase in the prime rate, the average mortgage payment goes up by $315. This is obviously going to be more in larger cities like Vancouver, $526, Toronto, $483, and so on, but the payments will definitely be going up across the board. So, adjustable rates going up as prime rises, causing worry. This isn't anything new. We've talked about this on this channel before. We've also talked about variable rates with fixed payments at great length, but what about those with fixed rates? What about those who are worried about their payments going up, who are renewing in the next couple of months?
What about us?
This poll gives us some insights into what is coming with the mortgage renewals coming due as well. When asked about mortgage increases and what it would do to household budgets, this poll indicates that for the majority of respondents, there isn't a whole lot of breathing room. For those who said they couldn't afford any increase in mortgage payments, or they would have to make serious budgetary changes in order to afford the increase, 36% put their threshold at $150 per month, 66% said $300 a month, and 82% said $450 per month. So while we've always known, and we've talked about at great length on this channel, how holders of adjustable mortgages were going to be most immediately affected by the increase in interest rates from the Bank of Canada, this poll shows that holders of fixed rate mortgages are getting more concerned as well. On March 25th of this year, Deputy Governor of the Bank of Canada, Sharon Kazicki, noted that those who are currently renewing their mortgages should receive an interest rate very similar to that they received when they first purchased their home 5 years ago, so back in 2017.
And people renewing over the next couple of years will likely get rates that are similar to what they're paying now.
Let's take a look at how these renewals will play out now that they're starting to come due, with these higher mortgage rates, higher interest rates in mind. In July of 2017, the average home price in Canada was $478,696, and RBC's best 5-year mortgage rate at that time, just as an illustration, their best mortgage rate was 3.24. So if we use that average price in July and we use that 3.24 interest rate on an insured mortgage with minimum down payment requirements, the monthly payment at that point in time was $2,302, and at the end of the 5 years coming due would be $406,267. Right now, a good 5-year insured mortgage rate is 4.99. So if we look at that $406K that's come due, using 4.99 on a 20-year amortization, because remember, you already paid 5 years worth. Using 4.99 as the interest rate, the payment goes up to $2,678.94, or about $370 more than it was for the past 5 years. Given that 66% of respondents in this poll said that a $300 mortgage increase would be a real problem, that's not a great sign. So I think Deputy Governor Kazicki did speak a little too soon in March of this year.
Jeez, really, you think so?
And I think 53% of homeowners, 53% of respondents on this poll are starting to get even more worried about these fixed rate mortgages that are going to start coming due sooner than you think, in the near to midterm future. Because the last few years have been characterized by such an unprecedented rise in our home prices, combined, probably caused by historically ultra low interest rates, I think there's a real tendency for everyone to only consider these pandemic home buyers. And what happens when those home buyers have to renew their mortgages in 4 or 5 years from now? But what we've seen today is that even those who bought prior to the pandemic, who bought still at relatively low interest rates, but definitely low compared to the interest rates that are out now, those home buyers are going to see significant increases in their mortgage payments as well. And as such, we are seeing even those with renewals coming up in the next couple of years, getting even more worried. And I think that we're going to start to see even more articles out on those homeowners who have to renew their mortgage at a much higher rate than they had 5 years ago. I think those articles are going to start to come out more and more in the next few months, as these increase in interest rates, as this increase in mortgage rates really start to bite at the time of renewal. If and when we do start seeing those articles, we'll obviously have updates out on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.